So let's see what we do have here. In this case, we originally have got a 90% subsidiary. So we pay $360,000 to acquire this 90% subsidiary. So originally, this is a 90% subsidiary. And later, something happened on 31st of August. On 31st of August, you dispose 60%. So it changed from a 90% subsidiary into a 30% associate. So it changed from a 90% subsidiary into a 30% associate. So that's why we have to consolidate until the day of disposal. We have to consolidate until the day of disposal as a 90% subsidiary. So we should consolidate until 31st of August, because the question says that we dispose this 60% on 31st of August. The question asks for the financial statements for the year end 31st of December. So that's why for a month, consolidation as a 90% subsidiary. And then for the last 4 months, September, October, November, December, 4 months, equity method. Right? So this is the last year that you have to do the consolidation, because this is still a consolidated subsidiary for a month. Right? For a month, this is still a subsidiary. So in your consolidated income statement, you should still include this a month results. Anyway, 90% subsidiary. So in the parent's own book, the parent must have recorded a profit or loss on disposal. So in the parent's own book, the parent has sold it, how much? So we disposed this 60% holding on 31st of August for $420,000. So the sales profit is $420. Therefore, we debit cash $420. So we debit cash $420. We credit investment. How much is the investments that we have disposed? 90% is $360. You did not dispose all, you disposed 60%. So you have disposed 2/3, right? 2/3. 60 out of 90, that means 2/3. 2/3 of 360 is 240. So therefore, you credit investments 240. Right? The question says that we account for this investment at cost. Therefore, the remaining cost, 120, remains in the financial statements. Right? So you dispose the 240, remaining will be 120 in the parent's own book. Because you get 420 by disposing an investment at 240 in the parent's own book, the parent recognizes a profit 180. Right? This is what the parent has recorded. Good. So this is what the parent has recorded. So now we calculate the same for the consolidation. On consolidation, the net assets increase because of the sales profit. The sales profit on the disposal of shares is 420. But not only this 420, because from the viewpoint of consolidation, the remaining investment should be carried at fair value. Right? So the fair value of the remaining 30%, the question says that the remaining 30% holding in buildings had a market value of $210,000 at the day of disposal, so it must be 210. So that's why it should be 210. So the net asset increased by 630 because of this disposal. But you lose everything with the subsidiary. You lose everything with the subsidiary. So you lose the goodwill, you lose the remaining fair value adjustments, and you lose the book value of the net assets of the subsidiary. Okay? So first, we lose the goodwill. The question says that the goodwill was 45,000, but 5,000 has been impaired. So therefore, the remaining goodwill is 40,000. If we did not dispose the subsidiary, we should have a goodwill of 40,000. But because we disposed already, no longer we can consolidate, and therefore we don't have this 40,000. Not only goodwill, we lose the net assets as well. We lose the net assets of the subsidiary at the day of disposal. How much is the net assets at the day of disposal? The question did not tell us anything about the assets and liability. Therefore, we calculate the figure from the equity section. So at the day of disposal, the share capital, 100,000. So the share capital is 100,000. Retained earning at the beginning of the current year is 304,000. Because the question says that the beginning retained earnings, 304,000. This is the figure on 1st of January. So on 1st of January, 304,000. But we have to consolidate for a month. Right? We have to consolidate for a month. So we have to share the a month profit. The question did not tell us the exact profit for the a month. It only tells us the profit for the year. So the profit for the year is 36,000. So on a pro rata basis, we think that a month means 8 out of 12. Therefore, the 36,000 is the profit for the year. A month means 1st of January up to 31st of August. We can share 24,000. So this is the equity. Equity in terms of the value means net asset. So the net assets up to 31st of August must be 428,000. Okay? Can you calculate the same? Yes. So we lose all this 428,000. No longer we can consolidate the subsidiary, but 10% of this does not belong to me, right? Because this is only a 90% subsidiary. If you keep on consolidating, you should have an NCI figure on consolidation. For this question, because we are using partial GUIL method, so that's why NCI is just the proportion of the net asset. So 10% of the net assets represents the NCI. Right? So if you find any remaining fair value adjustments, if you find any goodwill to NCI, remember to deduct it as well. Right? So you have to include. Everything include 3 components: book value of net assets, fair value adjustments, and the goodwill. Only here, because we are using partial GUIL method, there's no goodwill for NCI. Otherwise, you should have 119 goodwill to NCI, right? Which should be deducted because everything related to the NCI also eliminated. On a net basis, this is what we lost. We no longer can consolidate the subsidiary. So the net assets increased by 630, but it reduced because of the disposal of subsidiary. On a net basis, the gain on disposal is 204,800. Okay, so this is how we calculate the gain on disposal on consolidation. And then, of course, we keep on consolidating this subsidiary as a 90% subsidiary. And then suddenly, on the day of disposal, we have to clear this subsidiary. So therefore, we have to clear everything. So we need to prepare this journal entry. The journal entry means First of all, because in the parent's own book, the parent has debited cash and credited investments and credited profit on disposal, we have to debit away these investments and gain on disposal. Right? So we debit investment, 240,000. We debit profit on disposal, 180,000. This is what the parent has recorded, and we debit it away. So we first debit investments, 240. We debit gain on disposal, 180. If you combine these two journal entries into one, this simply means that we debit cash, 420. In effect, cash increased by 420. We debit cash, right? So if we combine these two journal entries together, because you consolidate the parent, right? So that's why this has been recorded in the parent's own book. And now you credit away investment, you credit away the profit on a net basis. This means we are debiting cash, 420. Because by disposing this subsidiary, actually cash increased by 420. Not only cash increased, you have got a remaining investment. The remaining investment must be carried at fair value. This means 210. 210. So this is actually what you get. You get cash, 420, and you get remaining investments, 210. Right? So you get this, but you lose the subsidiary. You lose the subsidiary. Therefore, you have to credit away the goodwill. You have to debit away the NCI because you keep on consolidating 90% up to the day of disposal. Then in your consolidated financial statements, you should have a goodwill, 40,000. So you credit it away now. You should have a credit to the NCI, 42,800. Now you debit it away. And then you eliminate all the property, plant, equipment, inventory, everything related to the subsidiary. On a net basis, the total of this net assets must be 428,000. It must be 428,000. You just clear all the net assets. Right? Here, of course, we say that we clear all the net assets. Of course, in the worksheet, you just don't add it together. Right? You don't add it. You don't add the property, plant, equipment, motor vehicle of these subsidiaries together. Right? So the net amount will be 428,000. Right? You did not add it together. They cannot balance, so the balancing figure will be profit on disposal. Okay, profit on disposal will be 204,800. If the question only asks for the consolidation, right? So this is the consolidation result after exactly or immediately after the disposal. Immediately after the disposal. If the question asks for reconciliation, the question may ask, why there's a difference between the gain on disposal calculated by the parent and the gain or loss on disposal calculated on consolidation? Actually, we should be able to reconcile. If you can still remember, the profit on disposal recorded by the parent is 180,000. It was 180,000. This is what the parent has recorded in its own book. Now you say that this is 204,800. As we have said before, the difference in profit is just a matter of accounting method. We should be able to explain. Because under consolidation, you accelerated the recognition of the profit. Because you keep on sharing the profit of the subsidiary. While if we keep it at cost, we don't share. So that's why because of the accounting method, we accelerated the recognition of the profit. How much profit we have recognized so far on consolidation? It is the share of the post-acquisition profits that we have shared, right? So at the day of acquisition, the retained earning was 250. At the day of acquisition, it was 250. Now, it is 328, right? The retained earning at the beginning of the current year was 304, but you have shared a month, right? So now it is 328. So you share all this post-acquisition profit from the day of acquisition up till now. Now is 328,000. This is a 90% subsidiary, so you have shared 90%. This is the profit that you have shared. Right? So basically, under consolidation, you accelerated the recognition of the profit by 70,200. But there's one further adjustment, because there can be many adjustments, right? Because you got those amortization of fair value adjustment, all the consolidation adjustments will affect also, right? Anyway, but here we got one more adjustment because you have got an impairment of goodwill. Because the question say that goodwill has been impaired by 5,000. If you are using cost method, you don't have this goodwill impairment. But on consolidation, you got this goodwill impairment. So the difference of profit recognition is also affected by this 5,000. So under consolidation, you accelerated the recognition of profits by 70,200, but because of the goodwill impairment, it has been reduced by 5,000. Okay? In normal case, this is the difference, because consolidation has accelerated the recognition of the profit. But here we have got one further adjustment, because this is not a full disposal. You dispose 60%, still you got 30% left. You still have 30% left, right? If you are using cost method, this 30% has been calculated at 120. Still remember, under cost method, you record it at 120. Because originally it is 360, you credited only 240, that means the remaining debit, 120. So under cost method, it is 120. But under consolidation, you have to record it at 210. Right? Actually, again, you have got a 90,000 difference. This explains why we got a difference here as well. Okay? So therefore, this is how we reconcile the difference. By consolidation, you recognize earlier this 90,000 increase. So the profit is higher, profit on disposal at this moment is higher than the cost method. Right? But later, if you dispose all, right, ultimately everything will be the same. Right? Total profit realized by a project throughout the whole life will be the net cash flow. Okay? Finally, no matter you are using cost method, fair value, equity method, or even consolidation. Good? This is not the end of the story. This is only the situation on 31st of August, right? Still, we got 4 months to go. 4 months. So, equity method for the remaining 4 months. We don't have the exact profit for the 4 months, so therefore we calculate by pro rata basis. The profit for the year is 36,000. Profit for the year is 36,000. 4 months out of 12 months, and you can share it as a 30% associate. So this is a 30% associate. Therefore, you debit investments, you credit share profit, 3,600. Therefore, at the year end, in your financial statements, the investment associate will be the initial cost. The initial cost is 210,000, right? Because you stay it at 210,000 here. This is the initial cost for your investment associate, and this has been increased because your debit investment 3,600. So at the end of the year, your investment associate will be 213,600. And if this subsidiary represents a major line of business, or if this subsidiary represents a major geographical area, it may amount to a discontinued operation. So if this is a discontinued operation, anything related to this discontinued operation should be extracted from the normal figures and we separately disclose. Therefore, we got this line, profit from discontinued operation. Some students say that they did not study this discontinued operation. Right? This is the financial reporting number 5, non-current asset held for sales and discontinued operation. Right? Anyway, if you did not, this is how we present our profit from discontinued operation. You include as a separate line. So that's why everything above it, those revenue, cost of sales, other income, distribution, administration expenses, include only those continuing operations. It does not include those discontinued operations. So from the sales, cost of sales, you deduct the sales, cost of sales of this discontinued operation, and the profit for this discontinued operation should be separately disclosed here. So here you have got the profit from the continued operation, and then you have got the profit for discontinued operation, and then this is the profit for the year. Okay? So when we analyze the profit attributable to the owner of the parent, you also separately disclose profit for the owner from continued operation and profit from the discontinued operation, and then this is the profit for the owner of the parent. And the same for the NCI. Right? So continued operation and non-continued operation should be separately disclosed.